Hi, my name is Amy. Thank you very much for watching, and let's make some bad financial decisions together. Today we have Michael Khouw from YieldMax. Please introduce yourself.
Yeah, so I'm Mike Khouw. I'm the strategist for the YieldMax series of ETFs that Title has on its platform. I'm also a contributor on CNBC. I've been doing that for the last, 17 years, maybe a little bit more. I think I'm going into my 18th year now. My background is options trading and institutional investing primarily. So I began my career as a market maker on the floors of the Philadelphia Stock Exchange, the American Stock Exchange, and the New York Mercantile Exchange. So I've traded options on a variety of underlying securities and assets. I have some sell-side experience. I was a block market maker at Cantor Fitzgerald, and I have some buy-side experience. I was working for a big long-short hedge fund in Los Angeles and some other buy-side institutions.
Good. Yes. So a few weeks ago, we were on the same Twitter space. It was the Wolf Trading, and you mentioned that you wanted to make a high-income portfolio. And that really excited me because I think that my audience would really benefit from having a discussion on how to build an income portfolio from scratch from someone that has so much professional experience. So have you created your 2026 income portfolio?
I have created the framework for it. And, part of it, I think it should be said that, of course, because in my role as a strategist, that does impose some restrictions a little bit on my ability to do certain types of things that I might otherwise do as an investor. So I'll give you a good example. We can't trade the securities in our own accounts that we would also be trading in the funds. That would obviously create some conflicts of interest, right? So we can invest in them. And so I think that's probably going to be the broadest sort of high level idea. I like to think of my investing with a certain backdrop of just an understanding about the way the world works. And there's a couple things that sort of go into that. One of those is that the value of the dollar, and this is something all of your audience already knows, goes down over time, right? It's that was not always true, but it has been true. If we could probably say that the change in that whole dynamic has been somewhat coincident with removing the dollar from the gold standard and the introduction of the Federal Reserve and things like that. But the net effect is that if the money supply grows faster than the economy does, then you will typically see the value of the currency go down, and that's what we have seen. The value of the dollar has over the last century lost about 99% of its value, a little bit more actually. And I think when people realize that, you say, okay, well, what that does, if I'm thinking about an income portfolio, is it sets a floor. And what we realize is that if you get an interest rate on your deposits of, say, 3% or less, you're losing money in real terms. And so, what people define as high income, or might have defined as high income, I would say in that crazy ZIRP period that we went through, the zero interest rate policy period, I think now people recognize that you need to be earning at a minimum probably 6% on your portfolio for it to even be considered an income portfolio at all, because probably the real rate of inflation is somewhere just north of 4%, even if the headline number's in the high threes. So I think that's sort of where you have to begin. The other thing is that whether you are buying fixed income securities that are based on equity or debt, that you want to have some collateral underpinning, the way that you're generating your income. So in other words, unsecured IOUs, which is maybe a business that the mafia gets into when they're loaning to people, they have a means of collecting that investors do not. We can't compel people to pay us back. So what we hope is that when we invest in something, that the underpinning assets actually have some value. And So that's sort of the basis for all of this as far as I'm concerned.
Yes. So yeah, I'm glad that I caught you as you're creating your framework, because as a professional, I feel like sometimes we are so used to working with it that we kind of just make the portfolio without thinking through all the basics. So for your income portfolio, are you going to aim to do all of your expenses, or are you going to just pay for some of your expenses?
My objective for year end, and I think a little bit of sort of an understanding of where I am in my life will probably also be helpful for folks. So I'm in my 50s. I have two, late stage teenagers, one who's going off to college next year. My wife is turning 50 this year. And so from our perspective, I think that, although I'm not planning to retire this year or next, I imagine that I'll probably work until I'm in my mid 60s anyway, or maybe even 70 years old, depending. If I like what I'm doing, I don't see any reason why I would stop doing it. But my objective is to get to a point by the end of this year that whatever I'm making just goes into the pool of assets, and that the income that we live off of and that pays our expenses comes from my investment portfolio.
Good. Okay, so by the end of 2026, it's going to be able to pay. So are you approaching this with a target for yourself for a percent that you're going to yield, or are you looking at more about the balance in your portfolio and growing it organically?
Well, I think that you do start with a budget, right? So there's two aspects: what you spend and what you make, and those things obviously have to be in step with one another. The objective I have is, number one, to bring in a little bit of the spending. We have one person moving out now. Of course, we have a college tuition to pay for. That puts a little bit of a fly in the ointment, doesn't it? But the objective is to get to a sustainable spending level, and then to say, okay, well, what then are my income requirements to make that work? And the other part of this is, will the income that I generate from this be sustainable? And by sustainable, what I mean is, if you invested, for example, in a conventional fixed income portfolio that was, let's say it was all bonds, right? Bonds typically that most investors are familiar with, they don't have rates that float. And even if they did, that would create problems all its own. So what you need is to have a pool of underlying assets that you expect will grow at least as fast as the rate of inflation will. Now, happily, there are a number of assets that do exactly that, generally speaking, at a high level. And of course, there's idiosyncrasies that exist with respect to, say, commercial real estate versus residential real estate. But real estate keeps pace with inflation, at least in general, and equities tend to outpace inflation, and often quite considerably at a high level. So at its core, that the good news is that creates a base of assets that should appreciate in step with or faster than inflation is devaluing your portfolio.
Okay, so for you, do you prefer having, are you more like a 3-fund portfolio type of guy, or are you more of a, let's just, spray and pray and have all of the ETFs in the entire existence in your portfolio?
So I'm definitely not a spray and pray type. I will say that for several years now, I have been absolutely opposed to almost any kind of fixed income investment with, that basically bonds is what I'm saying here, with one exception, and that is that for immediate cash requirements, short duration, commercial debt, of a decent credit quality, lower tiers of investment grade, so trip B kind of things. These types of instruments are a decent source of cash, understanding that equities will tend to exhibit more volatility, and I want to be positioned to take advantage of that. So I think of it as sort of a core portfolio aspect, an asset allocation, which is how much do I want to have invested in various asset classes. Most people are probably, as a percentage of their net worth, are probably allocated sufficiently to real estate, probably because their biggest asset is very likely their home in most people's cases. So they're going to be sufficiently invested there. And the rest is going to be equities. Now, within the equity sleeve, there's really two things that I will tend to think about outside of just generally being invested in equities. What would generally being invested in equities look like? That could be an S&P 500 holding, for example, like SPY. So within that sleeve, how much of it am I going to be relying on to generate income now? Now, once upon a time, equities, if you go back 100 years, they paid pretty good dividends. Almost all stocks did, and people could survive off of the dividends that they paid. And so then you would expect that the value of your holdings would increase if the businesses did reasonably well, and your income would increase, and you would have sufficient income to live off of. That has been less the case more recently because most of the biggest companies in the United States don't pay dividends, or if they do, they pay only nominal ones as a function of their own value. Part of this is tax related. So the way that companies return capital to shareholders is often through things like buybacks. So non-cash accretive activities, in the financing realm for these businesses is the way they return cash. And that's not necessarily as effective. Now there are, they've introduced qualified dividend rules, which has helped to a degree for investors that aren't going to be subject to double taxation. But, for others that may not be so helpful. So then I also have a sleeve of what I call sort of special situations. What are special situations? Special situations are those specific equities that I might be interested in investing in at any given moment. So my day starts, and I'm happy to show people exactly what it is that I'm looking at. But my day starts each and every day with taking a look at at what stocks I think are likely to do well or outperform. And this is sort of, that's within the idiosyncratic, okay, I'm going to be a stock picker for a portion of it. And then, within just the general investment, and I think, you and I spoke about this very briefly when we did that X Spaces or when you were asking questions about it. You can invest in products like Biggie, for example, which have a very close correlation to something like the S&P 500 because it's basically the 50 largest stocks. And if you take a look at the S&P 500, it is effectively the biggest stocks that represent it. And you can generate a very decent yield off of that and have a very stable asset base. I mean, stable as the S&P 500 is effectively.
So I actually do want to talk to you specifically about Biggie because I know that you really like it. And for just basically every Twitter space that I am in with you, you say, I'm confused why more people don't like Biggie. And then I come back to my audience and I say, it's because it pays 12% yield. So in your opinion, what is the advantages of Biggie over being in something like the S&P 500, or should it not be in the same area of your portfolio? Because it's kind of like when you build your portfolio, it should be like a pyramid of the S&P 500 bond market and then the theme stuff and then single stock ETFs. So could you put Biggie in the same category as the S&P 500, or what is your opinion on that?
Well, Biggie is effectively the S&P 500 with one critical distinction, and that is that it's making 1% distributions each month. Now, it's interesting to me, if you've been in the business as long as I have, to hear somebody say, well, a 12% yield is low. A 12% yield in my professional life is exceptionally high. That, in fact, if you had a bond portfolio that was yielding 12%, you would look at that and say it's probably it's a portfolio of fairly risky bonds, because if the 10-year risk-free rate is, call it 4% or slightly higher, and if corporates are getting a 200 to 300 basis point premium over that, so that gets you into the neighborhood of 6% or 7%, something that's in double that arena has a lot of bonds in it that have significant default risk. Instead, what you're dealing with is the 50 largest companies, publicly traded companies in the United States, which is effectively a pretty good proxy for the S&P 500. In fact, it's such a good proxy that for options traders that do something called a dispersion strategy, which is where you are trying to arbitrage the difference between the prices of options on individual constituent stocks in the S&P 500 and the S&P 500 index options themselves, or other proxies like SPY and things like that. Very often they will focus only on the top 50 because they represent such a good proxy for the market overall. And think about it this way: if you had $1 million in stocks and you were making $10,000 a month in income off of that, and the value of your portfolio was keeping pace with, or hopefully increasing slightly better than the pace of inflation, you're in a pretty good spot, I would say. So I don't think that's a bad place to begin. I think the headline distribution rates for some investments are what bring people in, when it's really the total returns that matter. The total returns for Biggie are quite good. In fact, I will just take a look quickly and see what, and by the way, if you want, I'm able to do screen shares.
Yes, please. We would love to see what you're looking at.
Yeah, so let me figure out very quickly how I do that. I can go over here, share, and let's see what this is. That's a window. I want to actually do a screen. Did I share anything?
Yes.
I hope.
I can see that.
Okay, so what you probably see right now is just an options montage for YieldMax, and that just happens to be one of the stocks we're looking at. For those who are not familiar with the black, orange, and blue and white colorway, this is a Bloomberg terminal. Bloomberg terminal is, one of the most broadly used by institutional investors. I've been using a Bloomberg since the late 1990s. In the late 1990s, actually, Bloomberg was not something you ran on your own machine. It was a machine that Bloomberg would bring to you. And they had their own proprietary box, and they would install it. It looked like an early Macintosh computer.
So it's like a black box. Did they actually make it black?
It was, the machine itself was actually not black. Okay. But the color palette that you see here, it has looked the same since the beginning. I believe that the operating systems that they use, some of it still dates back even to, mainframes and Unix and stuff like that. But if we're looking right now, what we're looking at is the 1-year returns for Biggie. This goes back to the first trading day of 2025, and and actually maybe I'll just go back to 2024. We'll go like this, and then we can compare that to SPY, for example. So I'm going to put, this is now SPY. I'm going to do the same thing. Oops. There we go. Okay, so we have Biggie here. So since December, the end of December of 2024, the total returns, if you had simply taken the dividends out from Biggie, are 18%. So remember, you've gotten 12 payments. You can see those payments annotated here in blue. Those are that's the distributions marked with the little D. And then you have this price change, right? So the price change is how much the shares have appreciated over the course of that little bit more than a year plus. And the dividends reinvested, this is assuming that you're putting it into, say, a money market account that gets 3.6%. If you had reinvested the dividends back in, so for people who are not drawing on these distributions, and whether you do or you don't, so sometimes you will see very good total returns. The nice thing about getting distributions is essentially it's an automatic opportunity to reallocate if you choose. But this has met the objectives that I discussed. It has generated a high yield. It has a very strong pool of underlying assets, the 50 largest publicly traded companies in the United States, and the shares themselves have indeed appreciated at or maybe slightly above the pace of inflation. I think the headline inflation rate now has dipped into the low 4s. Here we are in the high 4s. So it's sort of meeting all of these objectives. Now, if your objective is to simply go after a very high distribution rate, the caution I would give to people is that you have to be realistic about what kind of returns equity investments of any type, whatever strategy you overlay upon them, are able to generate consistently through time. Now, there's a very big difference between saying, what can a single stock covered call fund deliver for me based on its own idiosyncratic performance versus what equities can do generally. Biggie is a what can large cap equities do generally. And if you go back 100 years to the, and just take a look at, a large cap index synthetically recreated, you're going to see that the annual total returns for equities has, typically been actually below 12% up until relatively recently. And the reason I bring this up is because, we tend to be influenced by most recent events. So in other words, if equities have been returning 17 to 22% a year for the last 3, 4, 5 years, 22, we obviously were down. But if that's everyone's expectation, then they assume that's what's normal. And I tend to like to look back over a longer period of time to set my expectation. And actually, I look back at that longer period of time because sometimes, it might indicate that now's the time to overweight equities. I'll give you an example. So if equities typically returned, 10 to 12% a year, and we had 3 years where they returned less than 7, and the economy had been growing at a fairly average rate, and we hadn't materially changed, operating or tax rules such that U.S. companies were somehow at a material disadvantage, then my expectation would be some kind of, mean reversion over time, and that maybe now would be a time to get more aggressive with my equity portfolio. As it happens, over the last couple of years, we've had some exceptional performance, which is above average. Now, we can explain a lot of that. I've lived through several periods of exceptional equity market performance. I did in the late 90s, 98, 99, and early 2000. Saw, an exceptional period of equity appreciation. Most of us who are in the business recognized that was not sustainable. One of the reasons we thought it was not sustainable was because when we looked at equity valuations, you just couldn't get your arms around it. You would look at the prices for these stocks and you say, a lot of these companies aren't even making any money. So why do the stocks keep continuing to appreciate? That's a little bit less true now because, in fact, the best performing equities, not only are they making a lot of money, they're making money at rates that I probably 10 years ago would not have believed was even possible. And what I mean is top line growth, bottom line growth, after-tax margins. I mean, the after-tax margins for NVIDIA are absolutely insane. I mean, we're 70% gross margins, 53, 54% after-tax net income margins with 50 to 100% annualized growth. I mean, this is for a company that's, valued in the trillions. Really, I don't know that we would have even believed such a thing was possible. So it is a little bit different, but still, I tend to look at the long-term picture and say, okay, before we get too carried away and just assume that this will go on forever, let's look at larger data sets and see what they tell us.
So I don't know if I asked this specifically, but when you have set up your portfolio, what is the withdrawal rate that you're targeting? Is it the traditional 4%, or are you going to try to withdraw 8%? Like, what is the percent that you have in your head?
So, my objective. So interestingly, of course, I haven't really had a withdrawal rate before now because I hadn't been thinking about pivoting from spending a portion of my income and saving a portion of my income to living off of what my assets generate and just whatever income I make by other means, just putting it right back into that. I think of it a little bit as akin to, I think about two athletes who made, and actually one sort of well-known television personality who made a certain determination about whether they would save or spend their income. And those people are Tiger Woods, Gronkowski, the former football player from the Patriots and then Tampa Bay, and Jay Leno. So these are obviously famous people who had fabulous earnings throughout their lifetime. And in Tiger's case, he decided that he was only going to spend his winnings and he was not going to spend his endorsement money. And I think Gronk came up with something similar. And in Jay Leno's case, he decided he was never going to spend any money that he made from The Tonight Show, which is pretty incredible when you think about it, because the guy was making, I think 20 to, at one point, even $40 million a year. And his decision was, I have no idea how long this.
Did I lose you?
All the money I make. So, from my perspective, if you get to a point where you can live off of what your assets generate, and if you can grow those assets by earning money in other ways and saving into that, then that's fine. So from my perspective, it's more an issue of budget, things that I must spend. And I don't want to get into too much of it, but you can guess. Again, I have one kid who's going to go to college next year, and another one will be following shortly thereafter. That by itself is a pretty big demand on one's household budget. But that's essentially how I'm focusing it. So you can imagine that if the household budget is, just to keep the math easy, if it's $10,000 a month, and I have $1 million in Biggie, then I go with that. And if I'd like to see my budget increase, and then I'm just going to put more money into it. With every paycheck, more money goes into it, and hopefully that will grow over time. And one of the things that will also happen is that if the S&P has a pullback this year, and pullbacks are part of equity reality. I mean, that's just a fact of life. We had a big pullback in April of 2025. We had a bear market in 2022 intraday. I don't think we actually had an official close-to-close bear market, but we had an intraday bear market in 2022. If you are doing this, what that means is that all of those additional paychecks that you are deploying are getting, just by dollar cost averaging, are getting a better basis. So, if I start with shares at 100 and I'm suddenly buying them at 80, I'm buying more of them than I will be buying when I pay 120 for some of them sometimes, but just do it systematically.
Yes. So I asked that because even Biggie, when it pays 12%, if we're only expecting the S&P 500 to grow like 8 to 12% a year, then you do have to reinvest a portion of it in order to keep your same buying power for the long term. So
you're hitting on the key point, which is, what is your net asset value?
Yeah.
So the net asset value is essentially what is generating income for you.
Yes.
Now, when you're dealing with some of the people here, you might have rental properties, for example. There is, what is the net asset value versus what is the mark-to-market value, right? Mm-hmm. So happily, with things like exchange traded funds, there's very little divergence between the mark-to-market and the net asset value at any moment in time. So the net asset value on a per share basis reflects what the pro rata portion of the fund's underlying assets the shareholder is entitled to. And if you distribute money from a fund or from any investment more rapidly than the net asset value increases, you're going to have a problem in the long run. So, one way to think of that is if you owned an apartment building and you said, okay, well, I want to take 1% a month out of the value of my apartment building. But if you have a cap rate that is, call it 4 or 5, there's only a handful of ways you're going to be able to do that. You can defer maintenance on your apartment building. You could borrow against it. But essentially what's going to happen as you do that is that the equity is going to be going down over the course of time. And so one of the reasons I like to use Biggie as an example is that at least in its lifetime so far, which is relatively short compared to the history of publicly traded stocks, is that it has managed to accomplish both of these things. And we also need to be somewhat realistic about the fact that we can plan best we can but it is entirely possible that the market throws a spanner in the works, as they say, and we're going to have to readjust to accommodate whatever the market does. If we have a huge pullback in equities, there's going to be a lot of fallout from that, and we should be prepared for it.
Yes. Yeah, we should. So I'm just thinking about my own situation, which is not great. So is there going to be a point where you say, like, the portion that I have in my income portfolio is actually overweight compared to all of my other equities, my growth portfolio, and you'll start pulling it out of your income portfolio? Or is the income portfolio just, this is how much I need to live, and so we're just going to leave it alone?
Well, one of the things, that's something I would quickly point out is also going to be true about Biggie. It's also going to be true about things like Soxy and some of these other funds. And I mentioned these YieldMax products, but I think this is something that is also just generally true regardless of whose funds you might be investing in. And that is that if you're invested in the top 50 largest publicly traded companies, there is growth in there. Whether you elect to pull that out and spend it is one thing. And whether you decide not to is quite another. It's the same companies, right? So if I bought the top 50 stocks and I took no distributions, I own the same stocks. The question is, am I using those stocks to generate income and then spending that income and then taking whatever excess there is and perhaps redeploying it? Or am I instead putting it into investments that distribute nothing and spending the income that I'm making and not redeploying that? A part of the difference in one's thinking about this, some of that could be valuation based, and I'm not going to make a prediction necessarily about what the S&P is going to do in 2026. The market is up more often than it is not. The most recent economic data we've seen has been generally, I would say, better than expected. The most recent inflation data came in lower than many economists had forecast, and GDP growth came in substantially higher than many economists had forecast. And you put those two things together, that's pretty good for equities. We like that. We can add to that by also saying that this remains to be seen, but Treasury Secretary Bessent has indicated that the administration's objective, and it's not that spending and taxation are entirely up to the administration, because that's actually the role of Congress, but to the extent that the objective of getting the deficit to 3% of GDP or better, I don't really, there's no way I can model it and see it better than 3% GDP at this point, but let's just say that in an ideal world, if we can get down to those types of numbers, I think we're in, barring some other crazy thing taking place, I think we're in a pretty good spot. And, it's interesting because, I was looking at valuations for a lot of the fastest growing companies. And in many cases, I'm kind of surprised that, they're looking pretty decent. Now, I will add the following. I'm not invested in NVIDIA specifically, and that's only because I kind of feel like NVIDIA is getting to this law of large numbers area. So NVIDIA, as far as my individual holdings is concerned, is not a part of the program, but it is indicative that the economic environment remains strong for stocks. There is one other thing which I would just quickly point out, and it relates to this whole issue of debt and deficits a little bit, and that is where I think long-term rates could ultimately go. So the last time we had a sort of a very high inflationary period was the late 70s and the early 1980s, before the one that we experienced between, we'll call it February of 2021, and it's come off significantly, but call it the 4 years from that period onwards, was the late 70s and the early 1980s. And we had Paul Volcker was the chairman of the Federal Reserve at the time, and we saw interest rates get to double digits. I don't think that is going to happen again. And I don't think it's going to happen even if we saw a big return to inflation. And the reason is because our debt to GDP is very different now than it was then. And I think that what would happen is that the central bank and others would get to a place where they would recognize that trying to stabilize inflation the way it was done then would cripple the government completely. And so I actually think that there's probably a lid on long-term risk-free rates. And that I don't know where that number is, 6%, 7%, but it is in the single digits. I don't think that you would see anything like what we saw back then. And so that does change the calculus a little bit. To me, it means that it's unlikely that we're going to get to a point where long-term bonds become very attractive until we see some sort of reasonableness, as far as I'm concerned, because there's two risks that people who own bonds face. One of those risks is, well, there's a credit risk. So let's get rid of that. That's just defaulting, right? Somebody doesn't pay their debts back. You have the risk of inflation, and you have the risk of the nominal yield on those bonds rising, because when bond yields go up, correspondingly, bond prices decline. That's the relationship. So what would happen and we saw that in TLT. Like if you look at long-term U.S. Treasuries, they lost more than 50% of their value as rates shot up, and as we experienced inflation this last time. But also, what was left of the nominal value of those bonds was worth less money because of inflationary effects. So the real loss for risk-free bonds was probably 60% of your money. So that doesn't sound very risk-free to me. And so I kind of feel that because of this, people are compelled to invest in assets that can potentially grow or at least have some kind of dollar-adjusted stability, and that is going to involve having an excess concentration in U.S. equities.
So I would like to talk a little bit about the Target 25 ETFs that just came out.
Mm-hmm.
Is there like an unwritten rule that you won't be adding single stock ETFs that have typically less than 50% implied volatility?
50, I don't know. Well, first of all, when you add the ETFs, what happens to implied volatility once the ETF has been created? I think a good example of this is Strategy, formerly known as MicroStrategy. MicroStrategy was a stock that had a much higher implied volatility at the beginning of 2025 than it did at the beginning of 2026. Volatility for Bitcoin fell. Volatility of all the correlated assets, and including those companies and treasury companies like MicroStrategy, similarly fell. So I think we need to recognize that just like stock prices can move around, implied volatility, which is the price of options on those equities, can similarly fall or rise, depending on the circumstances. So in general, it's not likely you're going to see lower implied volatility stocks get added. And that's just because they're not it doesn't make a very compelling investment. I'll give you an example. I was looking at, there are different ways you can squeeze the balloon when you're net short options to get payoffs that you like. Let's say you're looking for income. If a stock has a low implied volatility, the amount of premium you're collecting for the options you sell is not going to be that high relative to the stock price. You need to sell strikes that are closer to where the stock is currently trading to achieve any kind of real yield off of that. So that's one way that you see it. Another way you can see it is by looking at things like call spread risk reversals. If I bought a 1 year at the money call, sold an out of the money call, and sold an out of the money put, just as a substitute for buying stock, and tried to do that in a way where I laid out no premium, that gives me some sense of whether options are, expensive or cheap. And, an example is you could take a look at a stock like MicroStrategy or Micron. Let's leave MicroStrategy out of it because it's its own thing. Micron Technologies, high implied volatility. You can, trade a call. And let's build it. Let's not just talk about it. I think if we show it, it's going to be a little bit easier. I actually happen to have built one here. This one goes out to May, But let's just start over. It's going to reboot. This system is one of our own systems. So
an in-house thing.
Yeah, it's a tool that I use it's something we built for our own use. And when I say our own use, I also happen to have a YouTube channel called Open Interest. So if you see OI in the upper left-hand corner up here, that's for open interest charting. So it's an internal charting application, but we'll just put Micron Technology in here for the fun of it. So there we go. And let's just go out 1 year in time, and I'll be able to illustrate just how much of a difference something like this can make. So we'll go out to January 2027. The stock is about 311 right now. So if I assume, what did I do with I always have my trusty HP12C here it is. So if we assume that, interest rates are in and around the neighborhood of 4%. So that gets me to 322.40. So let's just say I bought a 320 call. Okay. So a 320 call is going to cost about $83.65 per share, which is quite a lot. That's 27% of the current stock price to buy an at-the-money call option. And by the way, when folks were saying, okay, why is he figuring out the risk-free rate? Options have to accommodate risk-free rates because otherwise there are arbitrages. So, if I could buy a forward long-dated call and sell a forward long-dated put or buy the stock, in either case, I'm going to be long the stock for a year. Because the options trade is going to involve an outlay of less capital, I don't have to actually put up all the cash the way I would if I purchased the shares. The interest rate is going to play into the difference. So that's what we are doing there, is calculating the forward. Micron doesn't pay a dividend, so it's not that material. Okay, so now if we look at this, I've laid out $84. Now, if I wanted to have a zero cost trade, I now need to sell a put and I need to sell a call that are going to bring in almost $84. So that means I need to sell a put that's about $42. So I'll sell this one right here, which is the 1 year 250s. And I need to sell a call that's going to bring in about $42. So I'll sell this one, the 480 calls. So is everybody sort of aligned with what I've done here? So I bought essentially an at-the-money call option. I sold an out-of-the-money call option, and I sold an out-of-the-money put option to help finance it. And I end up with a payoff that looks a bit like this. So let's go up and down 2 standard deviations. So my risk here, I've in this particular instance, at the mid-market prices, I'm actually collecting a small amount of money. You can see that right here with that green region. So the stock is right here. I get participation up to the short call strike, which is 480. That's quite a lot higher, right? So remember that it's almost hard to believe that you can get that far out there. But so 480 is up 54% from the current stock price, right? Mm-hmm. And the downside risk in this trade is that I'm going to put the stock at 250. And so 250 is a 20% discount to this current stock price. So essentially, this is a trade that gives me more than 50% upside. And the worst thing that could happen to me is that I own the stock at a 20% discount to where the stock is currently trading. That number, by the way, and I happen to have looked at this before we came on today, is very close to the 50-day moving average for what it's worth. Now, this is an options trade that pays me no income, but it helps illustrate how high implied volatility can give you these kind of asymmetric risk-reward relationships that are attractive. Now, compare and contrast that with a really low volatility stock. What would be a low volatility stock? Well, how about something like Procter & Gamble, right? It's a staple stock. Procter & Gamble, it's not a whole lot of implied volatility. Now, if I go out and I say, okay, well, I want to do something similar in Procter & Gamble, So again, I'm going to go out to January of 2027, the monthlies, and I'm going to, now Procter does, as it happens, pay a dividend. So in this case, I have to factor the dividend in. So I'm actually going to use something that's very close to at the money in this case. So I'm going to take the 140 calls because there is a dividend. So I'm going to add the 140 calls in here. Hopefully my computer hasn't completely spun out on me. Oops. I don't want two of those. I only want one. Okay. So I have a long at the money call option. That call option is $12.50. So remember what we were doing before. So $12.50, give or take, versus a $140 stock price. This is now 8.9% of the current stock price. Remember what it was for Micron? It was a much bigger number. Yeah. So now I need to sell options that are going to bring that in. So I need to sell a put that's going to bring in, call it $6 and change. And maybe I sell, what was this one? This one's actually in $5 and change. So I'll sell this. That brings in $6. Now I need to collect, another 5 and change. So maybe I can sell this one here. All right. So now let's take a look at the payoff profile for this trade in a low volatility stock. Okay. This is the same shape that we had in Micron, right? But it is a lot less compelling because now I'm going to sell the stock at 155, which is up 10%, a little more than 10% from the current stock price. I'm going to be forced to buy the stock at 130, which is a discount of only 7% of the current stock price. And unlike the stock itself, I don't get a dividend, right? The stock itself would pay a dividend, and this options trade does not. So what this illustrates is just how important options premiums are to the relative attractiveness of using them on the short side. Now, you could, a different way to play this would be to say, okay, well, I think Procter & Gamble is going to get, acquired at some point during 2026. So I'll buy long call options, and they're not that expensive. Now, I don't happen to believe that. I think there would be antitrust concerns. It's not going to happen. So everybody, this is just a hypothetical. But it does go to your point. Your point was, do you create short option strategies on really low volatility equities? And the answer is, it doesn't generally make that much sense. It's not that attractive. If you want to get income off of Procter & Gamble, buy Procter & Gamble, collect the dividends. You're not going to make a lot, but you own Procter & Gamble, and that's that.
So I'd like to ask, for these target 25s, because they did just come out, is the asset under management, the growth of that meeting the projections that the YieldMax team had when they were? Is that something you can answer?
So it is, well, actually it's a little bit difficult for me to answer that one, if only because I think the target 25s were an idea that actually pre-existed my arrival. So I don't know what people thought they would do. Okay. When I became aware that this was a conversation people were having, I was very much in favor of them. And the reason I was in favor of them was because, assuming that you're looking at stocks that have suitably high options premiums. So when you're looking at something like Biggie, the top 50 names in the S&P 500, some are volatile, many are not, right? Just, you're looking at, even names like Alphabet, which is, part of the Mag 7 stocks, not a super high implied volatility. Good company, love that about it, but it's not going to generate huge amounts of options premium. So the target 25s, the way I thought about it, would be sort of a more targeted way, if you will, to identify stocks that could generate a consistent yield month over month. In a way that sort of a broad brush like a Biggie does not. So if you look at something like Soxy, it actually is sort of accomplishing what you would hope that a target 25 would do. And the reason is because semiconductor stocks are generally more volatile than the market itself is. Options premiums are higher than they are across all stocks. And that's because, if you're taking a look at the biggest companies, that's going to include things that don't have much volatility at all. Costco is a big company, but it's not a particularly volatile one. Options premiums reflect that. Procter and Gamble, another example. So the nice thing about the target 25s is it takes sort of a target 12 approach, but it's saying, you know what, we're going to do this stock by stock. So I'm just going to go down the list and I'm going to say, okay, Kroger, we're not going to do Kroger. We're not going to do Kimberly-Clark. We're not going to do Kenvue. We're not going to do Procter. Anything like that where you're probably just better off owning the equity if you're looking at it from income perspective. Those things pay big yields? No, but they do pay a yield. Procter pays a 3% dividend. I don't know what Kroger is now, but I'm sure it's okay. These are kinds of things that my mom is invested in, by the way. My mom's been invested in Kimberly-Clark forever.
Well, as you get older, you should get more conservative with your investments, things that pay dividends so that you can live off of the dividends.
Yes. It's interesting. I have a different view on this a little bit. I look at my parents as examples, and one of the things that's interesting, now, again, this is not going to be tax advice. Everybody should consult their own tax advice. But, my parents, how do they receive income in retirement? Some of it comes from stocks and bonds that they've acquired over time that pay modest dividends and modest yields, which bonds and stock dividends are typically not going to be that great. They own a couple rental properties. At some point, the house next door to them came up for sale when I was a kid, and it was a duplex. There was 2 units in it. And they were afraid who might buy it if they did not. And so they bought it. And they have owned it basically as long as I can remember. And of course, the thing is now long since paid off. And it generates a little bit more rent than it cost them to own and operate the property. So some of their income comes from that. They have a share. When my dad was working, he had a share in an office building with where he worked. They all built this office building. He had one, and some other people had offices in the same building. And he still has his, an interest in that office building, along with everybody else who had offices there, I guess. And so he has some of that coming in. But one of the things that many Americans will have is they'll have things like IRAs. And if you have an IRA, unless it's a Roth, is kind of a curious instrument because you haven't paid taxes on the contributions you made to it or any of the gains that you have been making. But then a time comes when you have to actually take distributions from that IRA, and those are taxable. And so the question you need to ask yourself is, okay, should that IRA then be invested for as long as I still hold assets in it? Should the residual assets in the IRA be in income producing instruments, or should that just be in things that have some capital appreciation? Because what's going to happen is no matter how you withdraw from that, you're going to have to pay taxes on those redemptions. And so to my thinking, a lot of people would say, oh, you should have your portfolio should be, related to your age. So, if you think that you take the number 100, you subtract your age, and that's how much equities you could be invested in. My parents are in their 80s at this point. So that would mean essentially no money in equities. Do I think that's a good idea? That they should be all in bonds? No, I don't think that's a good idea because I don't think bonds are making money in real terms. I think at best that's essentially like sticking, money under your mattress. And I don't like that idea. I'd rather you were invested in growing businesses. It introduces more risk. It introduces more volatility. But because they are getting Social Security checks and because they are getting rental income checks and they already were getting some nominal amounts of dividends and stuff from their other assets outside of their retirement accounts, I kind of think the retirement accounts, you should probably keep those invested primarily in equities, assuming you can afford to do so.
That is a really good point. So we're nearing the 1 hour mark. Do you have time to answer a few more questions?
I do. In fact, I'll take a quick peek. I don't think I do not have anything scheduled within the next hour, actually. I'm happy to make myself available as long as you like.
Okay, good. Because no interview with YieldMax is complete without talking about ULTY.
Yes.
So I haven't actually been covering it that much lately. After we had the switch up where we did the reverse split and we added the blue chip stocks, I was pretty happy with that, and I just was like, that's a next year me going over that me problem. But the thing I wanted to ask about ULTY specifically was, we knew that it wasn't working for a while before we introduced the blue chip. So I was just wondering, because I know that YieldMax, you're very deliberate when you do make your changes. And so sometimes, like as an outsider, it feels like maybe it's a little bit slow, but I understand it's a business thing. So I was just wondering, from the time it was identified that there was an issue with ULTY to the time that we introduced the blue chip stocks, like how much time was that like in the back office being talked about?
Yeah, I think that's a reasonable question. So I think there is, when it comes to adjusting the investment process, and this is not just true for ULTY. ULTY is a discretionary fund, which means that the fund managers and the traders have discretion as to the securities that they select and the strategies that they employ within the confines or the guardrails or constraints that are imposed by the prospectus. So the one thing that we have to sort of live with first is that the prospectus itself sets some guidelines as to how the underlying investments are going to be managed. And you can't deviate from that for regulatory reasons, as you would expect. You also can't deviate the strategy from the broader confines of 40 Act rules, the 1940 Investment Company Act, and things like that. And of course, so that's going to involve things like concentration and so on. So some of that is going to be deliberate because you have to update the prospectus. The prospectus was updated. I believe a sticker was put on the prospectus on December 8th, if memory serves. Don't hold me to that, but people who are checking can probably verify that's true. Incorporating, what you're referring to as blue chip stocks, I would just simply describe as stocks that were selected for reasons outside of implied volatility. ULTY, the name on the tin suggested that the constituent stocks were going to be high volatility. And we've already talked about what those benefits are. And we actually saw what those benefits were when ULTY was performing well. Let's talk a little bit about what happened when it wasn't performing as well. Now, all of this was going on very close to around the time I actually joined YieldMax. So I joined, I think, first week, it was right around Labor Day, I think, that I came onto the scene. Obviously have some experience running money in a variety of contexts. I am not the fund manager for ULTY, but I am a strategist and I am an options trader and I am an investor. So, we had an opportunity to collaborate. I actually did my own analysis, which I did not share at the time with anybody else. So I was just, for my own edification, I was just curious, what is going on in this fund? Why, during that period when it was outperforming, was it outperforming as much as it did? And why during that period if we're using the S&P as a benchmark, right? So it's as good a benchmark as any. What was going on when it wasn't doing as well? So let's talk about first its performance. And so what we can see here, the orange line, this is the total returns for ULTY. And what we can see is that, from the April lows, which looks like it's on or around the 8th, so I'm going to put that in as a starting date. And then it reached its zenith in early October, so that was the 9th. Oh, that's convenient because that works out to exactly 6 months. Right? So it had a 6-month total return of 33.15%. That's quite good. I think everybody would agree that if you're earning 66% annualized, which is approximately what that works out to be. Oops, that's actually.
Just so you know, I was very suspicious in April because I've been in ULTY in multiple points And finally in October, I was like, this is not stable, but I'll put 30% of my portfolio into ULTY.
So, well, let's actually,
not...
I had the wrong date in there because I was thinking to myself, I was
Yeah.
like, wait a minute, I said 66% returns, and I knew that actually the returns were much better.
Yeah.
Actually, the returns for that 6-month period was closer to 50%. Annualized, it was over 120. Now, what was the strategy doing? The strategy was looking for stocks that at least had suitable liquidity, because if you're running more than $1 billion and you have, call it 30 stocks in your portfolio, that means you need to have at least $33 million worth of liquidity in each individual stock for every $1 billion that you have in the fund. So, and you also need to have suitable liquidity in the options market. So there are plenty of good stocks out there. Some of them, the options market is incredibly thin. Maybe it trades 500 contracts, both calls and puts each day. And if it's a $100 stock, that's going to be very difficult for a larger fund to invest in. But in any case, the fund's performance was quite good. The reason the fund's performance was quite good was really fueled by two things. The higher implied volatility stocks tended to be higher beta, and the market was rising. So the value of the underlying stocks was going up, and we were collecting a lot in options premium. So that makes perfect sense. The other thing was that as you look at this orange line, you're going to notice that it wasn't really a very choppy ride, right? You can kind of see that. It was appreciating fairly steadily. Slowed down in this period here, and then again up until October was going up pretty steadily. After that, that was not the case. And even as equities sort of held in, or even went a little bit higher, ULTY did not. And what was going on? So that was what I wanted to investigate, and it's something I did investigate, is what happened between October 9th and the immediate period of underperformance thereafter that was not happening in the days preceding. So let's just look, what you're looking at now. Have you ever seen the movie The Matrix?
Yeah, I've watched some interviews with you, and it's just like the way that they became strangely correlated, I find so fascinating.
So yeah, I think this is a good example. So on October 9th, these were the holdings in the fund. So you can see we've got Rocket Lab, Palantir, CoreWeave, Robinhood. These are decent companies. Let's be honest. I mean, regardless of your view on these things, the other point we can make about them is that they are not necessarily highly correlated with one another. It's not like every single stock in here was related to Bitcoin, for example. We did have some that were. So an example is MicroStrategy. MicroStrategy was in here. BMNR, Bitmine Immersion, was in here. That's going to have some correlation to Bitcoin. Coin was in here. That obviously is going to have some correlation as well. But HIMSS is a generic pharmaceutical company. Yeah. And Palantir is principally a government technology contractor. Lucid is an electric car manufacturer. And Affirm is a buy now, pay later company. So it isn't like they put all their eggs in one basket from a business perspective, but it turns out that they ended up behaving a lot like each other. So for any viewers of yours who have not seen what you're looking at now, and I apologize because it looks like the Matrix, but it looks like the Matrix where you see all the funny things going down, because this actually is a matrix. What this is a correlation matrix. What it measures is the pairwise correlations of all of the individual stocks. A negative number indicates, like you see here with Lucid and Palantir, a negative number indicates that as one stock rises, the other one goes down. In general, what you're going to see is that there's sort of an interesting mixture, but it's not a highly correlated portfolio. When you see all of these ones, those are all perfect correlations because it actually does the pairwise correlations for every single company, also with itself. Of course, every company is perfectly correlated with itself. How could it be otherwise? So that's why you see all of these ones. And you're going to notice that, so that we don't have to memorize the numbers, just so we have a sense of what's happening, that when you have a high correlation, it's going to show up as white. So white is a highly correlated. So what you're going to see, which is what we were talking about before, is that coin and MicroStrategy were highly correlated, as we would expect, because they're effectively in the same spot. Let's see if we can find another one that's reasonably highly correlated. I bet if we find coin and where's Bitmine immersion, actually that correlation isn't even as high as we might expect. But in any case, that's what you're looking at. White means that things are highly correlated. So this is the 5 weeks leading into the fund's zenith. Now let's take a look at what happened from the fund's zenith to 5 weeks later. We'll go, now let's just go out to the 15th of November or thereabouts. There's a lot of white there. I mean, a heck of a lot of white. In fact, it feels like the whole thing turned white, basically, right? And, this is essentially what happened as Bitcoin rolled over. So Bitcoin hit its highs for the year in October. When Bitcoin rolled over, a lot of high beta stocks rolled over along with it. And basically what we went into was a very much a sort of a risk off of kind of an environment where people just said, okay, you know what? Bitmine immersion, Bitcoin, Palantir, Robinhood, I don't care. I mean, even something like Affirm, for example, you can see that Affirm's suddenly has got a bunch of white over here. People just said, I don't want any part of that. I want to move to lower beta stocks. And effectively, that's what happened. And so when you look at the fund and you say, well, I'm seeing these blue chip stocks, what does blue chip really mean? What it means is they're lower beta, right? It's, Robinhood was one of the best performing stocks of 2025. I'm an enthusiast of how the company is being run. I was at the Hood Summit at the end of the summer in Las Vegas, and it is very clear to me that that is a management team that is as enthusiastic as ever about the business. It is very clear to me that their customers, based on the 1,000 people that attended this thing, were also, that's a pretty good sample, right? So they obviously have many more customers than that, but 1,000 is a pretty good set. And that one could argue, well, the customers that show up for the Hood Summit are probably bigger enthusiasts. I'll go along with that. But there was a lot of enthusiasm for the things they were doing. And so, it's all good. But, the stock didn't do so well as things kind of rolled over there. And so what happened was the prospectus was amended slightly. And there's two big changes that were made. One, Michael Venuto, who's the CIO of Tidal, and Jay Pestruccelli, who's one of the fund managers, and the determination was made to look for what we call a non-correlated sleeve within the fund. And what does non-correlated? You can have highly correlated, you can have non-correlated, or you can have anti-correlated. Anti-correlated are those examples I was providing earlier where one thing goes up and the other one goes down. What would an example of things that are potentially anti-correlated be, or at least non-correlated? I don't know, oil prices and airlines, right? Airlines are, one of their biggest expenses is jet fuel. When oil prices decline, that's generally good for them, but it's not so good for oil companies, right? So we wouldn't expect to see high degrees of correlation. So a portion of the fund was, sort of deliberately non-correlated. And things that you will begin to see in there that I think are examples of that is you saw gold miners, things like that were introduced. Can they be correlated with technology? I suppose they could be, but they don't have any functional relationship which would suggest that correlation between those two areas would persist over time. So that was one part of it. And the other was to just look for, a little bit of it that would be slightly lower beta. And, that has been done. And look, it's an actively managed fund. They are just giving themselves a little bit more flexibility depending on what conditions the market has. they'll, I'm sure, adjust these things accordingly. I will say that because I have some visibility on the stock selection process, the things that do go into it are things like momentum. So does the stock exhibit positive momentum? Other things that are going to go into it include, whether or not the street's forecasts for forward earnings and revenue growths are remaining somewhat consistent. So these are among the factors that go into it as well. Implied volatility has to go into it because this is a fund that's looking to harvest that. But, and that remains a very high ranking in this. But some of these other factors are their respective weights for how they go into the security selection process has increased. And then the portfolio management itself saying, okay, well, how much is going to be in a non-correlated sleeve? That's sort of being managed a little bit more, with a I would call it a higher degree of, risk testing, shall we say?
Yeah, I've always liked ULTY. And it's not always been the best thing to be invested in, but I like the experiment of there's no theme. It's just give us as much money as possible for what you're doing. It's just that, I think you said this in a Twitter space where when you give fund managers your money, you're kind of expecting to at least get you're now stable or just wanting it to be keeping up with inflation and then getting whatever yield. So ULTY, I know that it's more risky. It's going to go up and it's going to go down. But for me, as just a person, I have to believe that when the market recovers, ULTY will also go up and recover, because otherwise you're just going down and it never recovers. And so that's not really a question, but
yeah. Well, no, here's an important point. You hit on a really important point. And I think this is something that people need to understand also. And that is that there is a remember we were talking about tax considerations in IRAs, what you should be invested in, just knowing that you're going to have to pay taxes on withdrawals. These funds, because they trade fairly actively, they also have to adhere to tax rules as well. And these funds are intended to be what are called pass-throughs. And what a pass-through is a fund which is not subject to double taxation. So if I invest in a company, they are subject to corporate income taxes. And if they pay a dividend, depending on my circumstances, I may also be subject to income taxes. So that would be double taxation. We don't like that if we can avoid it, because that can seriously impact one's returns over time. What really matters is your total return net of taxes. So understanding that, in order to maintain pass-through status, a fund must pass through 90% of the income, interest, and capital gains that it realizes. That's the critical word, that it realizes within a given tax period. So what that means also is that if the underlying stocks inside of ULTY appreciate, ULTY might appreciate. If we realize gains by selling those stocks at a gain, and those gains outpace any realized losses that we were able to use to offset at the same time, those gains will very likely be passed back, or at least 90% of them will have to be, or the fund will be subject to corporate income tax, which is about 30%. So we don't like that. We don't want that to happen. And so that's one of the things, not only about ULTY, but about any fund that does this, is that there are going to be limits to how much appreciation you can have over any period as a function of what has been realized versus what has been unrealized. If you have unrealized gains, or you have gains that have good offsets, then you're not going to have to see these distributions, but otherwise you would. And so that's one of the reasons why people say, well, it seems like we're not getting as much of a boost. You're selling some upside away. That's the first thing. But the second thing is we're also distributing a lot of gains if and when we get them. And that those two things in concert with one another will have an impact on the potential capital appreciation. Just even in Biggie, it has an impact. If I make 15 or 17%, I think, as Biggie did last year, over a year, well, you can't have 17% capital appreciation and have 1% distributions per month. you have only so much gains to deal with, depending on how much you pass back. So I think the important thing is that always monitor the holdings in these funds and the strategy, and provided that you see the stocks that are in it, and we can even take a look at what's in it right now. I'll do that so we can all sort of share that together if my Bloomberg will cooperate. There we go. And I'm just going to sort this by the current market value. So there we go. So, we've got Jabil Circuit in here, Quanta, Palantir, which was in there then, still is, Broadcom, NVIDIA, Robinhood. So you'll see that some of these stocks that were in the fund even then remain in it now. Some of them are newer. An example, Southern Copper. So Southern Copper, is it anti-correlated with these others? No, but is it perfectly correlated? Probably not. That's kind of a non-correlated space. Eli Lilly would be another example. We hadn't seen, it's probably not the highest implied volatility in a name like Lilly. Las Vegas Sands clearly is not necessarily correlated with some of these. So, although I will say that, there's a lot of cross currents. This is just something worth noting for investors generally, which is that, if you see a lot of economic growth, that has an impact on prices for commodities like copper. Copper is an industrial metal, but it's also used in a lot of the hardware, right? So copper is used in these things. So you're going to see some impact there. Corning is, another kind of a company that they make a lot of things that don't necessarily correlated to technology related trades, but they make some things that are. So, people wouldn't necessarily think of Corning and Apple in the same sentence necessarily, but I think Corning was the maker of Gorilla Glass, which at one point they were putting on iPhones. So, sometimes there is a relationship there that is worth observing. But if you are comfortable with the stocks that this fund holds, and you would have them in your own portfolio, and if you are similarly comfortable with the idea that you want to sell options premium as a part of an investment approach to generate yield, then ULTY should still be appealing to you. Just recognizing that some of these stocks are higher volatility than the S&P is generally. Broadcom, good a company as it is higher volatility than the S&P. Analog Devices, Las Vegas Sands, all of these companies, that's true. So one should anticipate that. That's also part of the reason we're invested in these names. Not part of, it's a big part of the reason we're invested in some of these stocks, because we're trying to capitalize on that, which is where we began this whole conversation. We illustrated that short option strategies aren't that appealing in the Proctors and Kimberly Clarks of the world. Yeah. It's more appealing in these types of stocks.
I have two questions about this. Is there any chance that we could get like a HAVI that's just ULTY, but strikes that are further out of the money? Like kind of a target 25, but not, because you can't do the strike price at what you're doing and keep it back.
So you want to squeeze the balloon so that you get more capital appreciation yes. and less. So, we have some target 25s. We expect to launch more of them. We have, another fund that we have out there is YieldMax. What does YieldMax do? YieldMax invests in a lot of the single stock covered call funds. So when I think about it, I imagine you have a whole bunch of target 25 single products, and then you have a fund of funds that captures all of those. And ultimately, I don't know if that's, there's a lot of things on the roadmap. I know this is something that has been discussed. If and when that will be released, I can't say. Number one, I'm not a part of every one of those conversations. And the second thing is, even if I had been, which I wasn't, but even if I had been, I would still be at some limits to what I could say until we actually make a public statement, just because of the rules of the road. So once we make a filing, but I would say watch this space. That's what I would say, because I think the adoption of the target 12s hasn't been what I would have expected, given their performance, which I think is quite good. But their performance does speak for itself. And my guess is that investors will eventually find their way there. And I think the target 25s are going to be very similar.
Yes. And the second one, I know the answer is no, but I would actually like to see YieldMax.
Okay, then I'll say no then.
Yeah.
If
So,
you already know the answer.
but, I would actually like to see a version of ULTY that doesn't pay a dividend, because it's actually hard to find an ETF that has a similar constituents in it, because ULTY doesn't have any rules to it. So if I could use some of my distributions to buy into that,
Well, you know what is interesting about your comment, which is that I'm guessing the reason you say that is because your intuition suggests that these stocks outperform the market in general. Is that kind of what your feeling is?
Yeah. So instead of reinvesting in ULTY when times are good, I could invest, in it in the growth portion and use it to balance it, to get my own target 25, what my own target would be for this.
I think I have something to show you that you're going to find kind of interesting. And I'm just looking at the S&P right here. And this is this is kind of how I start my day. But this is something that your intuition is right. Let's start with that. So your suspicion was that higher volatility stocks tend to outperform, right? So let's examine that. And so what we're looking at here are a variety of factors. I have about 235 investment factors that I can look at for any universe of stocks globally at any point. They could be how volatile are these stocks? How fast are their earnings growing? Are analysts increasing or decreasing their revenue and earnings assumptions? All kinds of things like that. And as it turns out, higher volatility is one of those characteristics that has been shown to have some increase. So this is a spread of implied versus realized, meaning that if it's lower, that means that the realized volatility, the higher the volatility of the stock, the better this does. So let me see if I can find like this. Okay. So what this is doing is it's taking a look at the performance. Let's see if I can blow this up. Do you see this chart down here in the lower right?
Yes, but it feels like an eye exam.
Yeah, I apologize for that. Let me see if I can make this thing look a little bit bigger or better. So I'm going to look at periodic results, and can I expand this?
I'm laughing because I was like, why does it say Jim? No, it's 3M, Amy.
Yeah. So what we're looking at here, let's see if I can blow this up a little bit. So this chart right here, what this is showing us is how stocks that have a higher volatility have done relative to lower volatility. So where you see a bar below, and actually I'm going to do cumulative like this. See, I knew I had a mechanism to blow this up before, and how do I do that? You know what I can probably do? Is I can probably well, I'm hoping that, if I had known that I was going to be showing this, I actually would have built a chart that was a little bit easier to read, because I realized with a screen share, it's probably not that great. But basically what's going on here is if you use volatility as a factor, you can, and all I did was I just took a look at the S&P 500 and I said, okay, those that have higher realized volatility, relatively speaking, so I break that into quintiles. The top quintile in terms of what I want to buy is this yellow line here. And I compare that to the lowest quintile. So I basically break a group of stocks. I filter 500 stocks. And I say, I'm going to take the top quintile and compare it to the bottom quintile. That's the performance difference that you get. And it's big, right? As you can see. It actually has a Sharpe ratio of 2.4. Sharpe ratio is a sort of a measure of risk-adjusted rates of return, and it has a very high what's called information coefficient. When we're doing factor analysis, you look for relationships, factors that you can look at that illustrate that stocks like this are likely to outperform. And so your intuition is correct. It's actually one of the better, believe it or not, it's one of the better factors one can examine as it happens. And it, one's intuition might not necessarily lead you to that place. There are other things where you could say, okay, well, I understand why a factor like that would have some benefit. So here's an example. You see this momentum category right here, where I'm using and it says 7-day average stories. It turns out that if a company has more stories being written about them, that they tend to outperform companies that have fewer stories written about them. And I guess that makes some intuitive sense, right? Because if a company has a lot of stories being written about them, money will tend to flow in. Maybe it's in response to the stories, or maybe the stories are in response to the money flows. Who knows? But there is a relationship that exists there. There are other things too, including things like what I was just talking about before, revisions. If a company is having negative earnings revisions, those companies tend over the next 30 days to underperform those companies that are getting positive earnings revisions. And so there are a lot of different factors that go into it. But when you say, well, these higher volatility stocks, you looked at them and just intuitively said, wait a minute, those aren't the fastest growing publicly traded companies. You just kind of got that sense just by eyeballing it. They tend to be higher volatility. They tend to be higher growth. And as your intuition led you to believe, they actually tend to outperform as well.
Yeah. So I remember the YieldMax 100 fund of funds is coming out soon, right? We're the 100% Yielders Club. This is also not a question, but I would love if YieldMax published more fund of funds, but had exclusion criteria like the 100 best, where it's like you have to have had that 100% yield at least once in the last 12-month period. Something where it's like YieldMax, but if you've had like a negative NAV for the last 3 months in a row, we exclude you. And we are, something, because with YieldMax, in theory, I was thinking, okay, well, as we add more funds, get more diversified, and the price will stabilize, and we'll have, a pretty okay distribution. But YieldMax, I actually have like quite a big loss on it. And it's like, I feel like 5V and the Mag 7, it's too few things in there. Like I like 15 to 30, because then you have like a proper like diversified holding. So that's just an observation for me that I would.
So there is a bit of there's a bit of a portfolio management issue that's going on. If you take a look at YieldMax, one of the things you're going to observe is that it's equal weight.
Yes.
Now, what does this have to do with portfolio management, and is it a good idea or a bad idea? Let's exclude YieldMax for the moment, and let's think about just the broad market. The S&P 500. The S&P 500 is a cap-weighted index. So the larger the market capitalization of a company, the bigger its share of the index is. I think most people recognize that. Now, there are two really important benefits that a cap-weighted index has over an equal-weighted index. What are those? The first is, well, you don't really have to do a lot because it does it itself. If I said, okay, here's a universe of stocks and we're going to cap weight it, I can initiate a position into some list of stocks. It could be 5, it could be 50, it could be 500, doesn't matter. And I just weight them on a pro rata basis. Well, the beauty of that is that once I've done that, assuming I never change the constituents, I never have to do anything else because it's self-adjusting. As a company grows relative to the other constituents of the index, it will grow as a percentage of the portfolio. If I'm equal weighting, what happens? Well, as one grows, it becomes outsized in the portfolio. I therefore have to sell some. And as one shrinks, it becomes undersized in portfolio, and I therefore have to buy more of it to maintain that equal weight. Does this sound like an investment strategy you want to get involved in? Selling my winners to buy more of my losers?
Technically, yes. It doesn't feel
Well,
great, but it depends on if you feel confident and you have conviction in the one that's underperforming at the moment. Then,
in this example, though, those stocks it's not that I had a view about them. Let's say I was just taking the top 50. I didn't have an opinion that I really liked the biggest one and I liked the smallest one less. I let the market make that determination. Yes. And then I'm letting the market do its thing. Whereas if I'm equal weighting, then I am making a judgment call myself, effectively, that I think I own too much of the best performing stock and I don't own enough of the worst performing one. So your winners run and cut your losses quickly. Have you ever heard that?
Yeah.
Yeah. I mean, so this is kind of the opposite of that. If someone says, I want to have an equal weight portfolio and I'm not going to make judgments about companies and I will just buy more and more of the losing stocks because they're going down and I need to get it back up, that does have it has a negative impact, which means that if I have a holding that is not performing well for whatever reason, that I'm going to continue to throw more money at it. And if I have something that's working really well, I'm just going to take money out of it and not let it go. This doesn't really work in the long run. One of the reasons the S&P 500 has done so well is because it essentially lets those winners run for as long as they do. And if a company does not do well, its impact on your portfolio diminishes through time as it shrinks, and eventually it gets tossed out. I saw this, I didn't verify it independently, so it may or may not be true, but I saw something published last week that said that only 199 of the stocks that were in the S&P 500 in 2000 remain in it now, which means quite significantly that 60% of the S&P 500 has been flushed out in the last quarter of a century. And I thought that was very interesting. That number came as a bit of a surprise to me. I wouldn't have thought it would be as big as that. Now, of course, there's also corporate actions. Let's just bear that in mind. So that means that companies acquire one another and things like that happen. But, the impact of letting your winners run is very powerful because NVIDIA has had many years of exceptional performance. And there have been many instances along the way where one might have been tempted to sell the stock. But had you done that, I mean, look at this. This is basically, we're talking about, look at those returns, right? So I went back to 2000. 192,000%. 192,000%. And how many instances, if you had decided, if you had initiated a portfolio at the beginning of that period and said, I want to be equal weight, you would have been selling NVIDIA all of that time. And that unbelievable, a 2,000 bagger, $1 turned into 2,000, would not have happened. Yeah. You still would have done well, but you wouldn't have done anywhere near as well. And what about Moderna? We'll look at Murni, for example, which is the covered call fund that tracks it. Well, one of the reasons it has done as poorly as it has is because Moderna itself has done very poorly, right? Moderna has lost more, I think, than 90% of its value, peak to trough, if my memory serves. This is not a pretty picture, right? So if I was doing an equal weight portfolio and my whole portfolio was only two stocks, Moderna and NVIDIA, and every single time NVIDIA made a little bit of money, I sold my NVIDIA, and every single time Moderna lost it, I bought a little bit more Moderna, that would not have done as well as just saying, okay, I've got $100 to invest. I'm going to put 50 in Moderna. I'm going to put 50 in NVIDIA. Well, NVIDIA took off. And I would have long since forgotten about what happened to Moderna because of the gains I made in NVIDIA. But if every single time I made a little bit of money in NVIDIA, I redeployed it to Moderna, it wouldn't have been a very pretty picture.
So
because
what
Moderna
I'm
has
hearing
lost most of its value.
is that we need like a YieldMax 30 of the cap weighted 30 best performing single stocks from YieldMax and just let it be.
I am a big believer in the power law. The power law is that's what's at play here. Now it works more in really big constituent situations, so it's probably preferable to the more of these things that are out there. And as an individual investor, how do you do that? I did an analysis, and in my analysis, I took a look at every single YieldMax long equity product and assumed that on that day, you took $100 out of the S&P and you put $100 into that product. And you didn't touch it, right? Whatever came, whatever happened, you just let it go. So that means I put $100 into Moderna, into Merni, and I put in $100 into NVIDIA, or into Soxy, or into Biggie, whatever it was. I just took a look at the performance. And when I did that analysis, that strategy outperformed the S&P 500. Now, there was staggered, because funds were rolled out at different times. It wasn't like you could take a specific day. Every single time a new fund was added, you would assume that you took $100 out of the S&P and plowed it into that. And it had very attractive risk-adjusted rates of return. The risk-adjusted rates of return actually improved through time by diversification. That makes some sense because if all you ever had was Misty, for example, you had gangbuster returns one year, and the returns the next year were not so good. So you put those two things together, diversification has a powerful impact. But my point is that if you let your winners run, even if you don't cut your losses early, that they have a tendency to cut themselves because, they can only go to zero, but some of these funds can go up more than 100%. So, that's true for stocks. It's true for anything, right? So in general, I'm a big believer in the power law. I'm a big believer in not trying to mastermind things. It's one of the reasons I always get frustrated. Every year on CNBC, we do this thing called the acronym challenge. And the acronym challenge, they say, okay, what are your best ideas for the year? And I always felt like this is quite arbitrary because I have a general sense for how I think one's investments should look. Just from strict trade management, there are situations throughout the year where if something is proving not to work, I should just be able to pair that and say, you know what, I'm not going to do that anymore. So let me just cut my losses. That challenge doesn't let you do it. And it also makes the assumption that somehow magically my opinions about the way the investment world and landscape are changes magically from December 31st of one year to January 1st of the next. And that is definitely not the case. So I kind of think that if people invest, consistently deploy, which is also consistent with this whole notion I have about, creating a portfolio for income, is that, you have to have a disciplined approach and you have to be willing to stomach some pain and some bad investments, because that is just a reality of investing. I heard about a study. It was kind of an interesting study. It was a study between rats and people. And they had these two different options where people or a rat could, choose one color or another, and they would get a reward. And, we'll say it's red light, green light. So if you hit the green button, 80% of the time you'd get a reward, 20% of the time you'd get a shock, right? And the red one was exactly the opposite. And what they found in this study was that rats sort of figured this out pretty quickly. And they always hit the green button. They knew they were going to get shocked 20% of the time, but that was the price they had to pay to get the reward 80% of the time. Humans underperformed the rats. And apparently they underperformed because they thought they could divine some kind of pattern. They thought, oh, wait a minute, it's been green too many times in a row. Like it got 10 greens in a row and it all worked. So it's got to be red. So then they would hit the button and so in the aggregate, they underperformed. And I think that there's a temptation in investing to deviate from the things we know we're supposed to do for that reason. Just a sense that somehow we can outthink it, we can outsmart it. And I don't think that that's true. I think, as a general rule, follow the general rules and live with the consequences of that, both good and bad.
I mean, that's pretty much been my philosophy. It's like, if I believe in a theme of a portfolio, I'll just put in money, and it is what it is. I made the bet, so gotta lay with it. So going back to the beginning of our discussion, when you do implement your income portfolio, would you be willing to put it on Blossom? At least there's different ways you can do it, where you can do it manually or actually hook up your account to it so that people can see what your portfolio is.
I'm not familiar. I'm not connected with Blossom. I might have set up something with Blossom, so I'm not 100% familiar. I know how that works. I don't have a problem with that in principle. I better check with compliance, I guess.
Yes.
Yeah. Before I answer something like that, which is disclosure based, I should probably double check.
Okay.
In principle, I don't see a problem with that.
Okay. Yes.
Let me talk with the team and see what they have to say about that.
Yeah.
But yeah.
You all put it, or at least I heard that you can put it on Morningstar. Like, you have to disclose what you have to Morningstar anyway, right?
Morningstar scrapes filings. We don't disclose anything to Morningstar, and I don't think they're getting information directly from us. It is interesting because I actually reached out to Morningstar about something where they were saying, it shows that the fund managers don't hold any of these funds. Where I know that Jay Petrocelli, for example, does. I happen to know that Michael Venuto also does. One of the reasons I happen to know that is because there was a settlement issue on distribution several weeks ago, and we were using Michael Venuto's accounts to evaluate, because he has, I don't want to point fingers at his broker, but his was one of the affected brokers. So we thought, oh, okay, well, good. He was affected. We had other people who were not, so we're just going to monitor his. And that did not show up in Morningstar's numbers. In Jay's case, I believe it's because there's a legal entity that holds some of his personal holdings. So you have to look for the filing. I don't know whether it was Zega or something else, but he has a legal entity that holds some of his holdings. I don't know what the name was in Michael Venuto's case, but so those things also don't get updated that often because it's like a filing issue. So you get to a point where a filing is required, and then you file with the SEC or whatever, and then Morningstar scrapes that. So Morningstar is not getting information, as far as I know. I don't think Morningstar gets any information directly from the fund managers themselves about that. I think they're just scraping, filings probably off of the SEC Edgar website or something like that.
Okay. I mean, that's good to know. So what are your thoughts on, so the income space is evolving, and now we're seeing more stacked and more leverage. So what is your opinion on those new kind of products? And you think YieldMax will adopt any of that?
Well, I guess the first thing I would say is that generally I'm more in favor of flexibility for investors and for fund managers at a high level, meaning that if investors want to buy levered products and fund managers think that they've divined a decent strategy that employs leverage, I think they should be able to create those products, and I think investors should be allowed to invest in them. We don't have levered products ourselves, and to me, leverage is a double-edged sword, and people can employ leverage on their own in other ways. Like it's not entirely clear to me. There are instances where there's benefits for investors to get leverage employed by the manager. Let me give an example. You might have a restricted account that is unable to get leverage because you don't have margin, or you don't have customer portfolio margin, which is a higher tier of margin, and you want to avail yourself of it. In those instances, I suppose there can be some benefit. Maybe you have a self-directed account that would otherwise be ineligible regardless of your own ability to get margin in other accounts. And so there's utility in that. In fact, if you go back in time, there are some levered, just straight linear leverage ETFs that have performed very well over the course of time. And there are people who might have said, I wanted to have that in accounts that were otherwise ineligible, and they would have outperformed if they'd had access to them. So I don't take issue at all. I think there's a lot of folks who are in the business who are ready to say, well, that's not my product, and I think it's crap, therefore. That doesn't necessarily mean, though, that we would necessarily deploy it, right? So
that makes sense.
I don't know that there has been much conversation. If there has, I haven't heard it. So my guess is we probably aren't going to be going too much into that space. There's a lot to be done within the things that we're already doing. And, it's a constant job to try to work, number one, to enhance the performance and strategy, and number two, to adapt to changing market conditions, which is, a lot of these things, like ULTY is not set and forget. Salty is not set and forget. So, some of these are more formulaic, in the sense that it's not a huge thing to manage the strategy, other than the logistics and mechanics of actually trading them from one day to the next. And we have a big trading team that can do that. But we have a lot of work to do, just our own row to hoe, so to speak. So we should probably stick to that.
Good. Okay, so it sounds in your situation, because you're involved in finance, these high income ETFs are actually convenient because you're not allowed to actually do your own options and do trading on these securities themselves. That's correct, right?
Yeah, so in general, every firm has slightly different rules on this. But the general rule is, individual investors have more flexibility than institutional investors do. And when I say institutional investors, I'm talking about people who work at regulated firms. So there's regulated buy-side firms, of which Title and YieldMax are the regulated buy-side, and there's regulated sell-side. Think Goldman Sachs, Morgan Stanley, Cantor Fitzgerald, where I used to work. And we had significant restrictions on the things that we can do. I actually, in many cases, felt like some of those restrictions were overly restrictive. I really thought it was kind of ridiculous. But, in many cases, your brokerage accounts are tied to compliance systems, and you actually have to go through a process and say, okay, I want to buy this, I want to sell that. And then a request goes in, and your platform will not let you do anything until you actually get that permission. And then once you've gotten it, there were often holding period restrictions. So at Cantor, I'm trying to go by memory because it's been a number of years. I think it was a 30-day holding restriction. So I had to get 3 days prior approval. And then once you got into something, you weren't allowed to change it for 30 days. And what's the net effect of all of that? Well, if you're an active market participant and you're saying, okay, well, I have to wait to get approval, then I have to wait 30 days before I can do anything. And oh, by the way, I might not get the approval that I want. It makes it very unappealing to do any kind of aggressive and active investment or trading strategy, because number one, you can't put it into effect. And then you're also concerned about getting locked into it once you've done it, because for whatever reason, they say you can't trade it. What would be an example of a situation like that is if a name became restricted. So if your firm is engaged in a relationship with the security that's involved, that could impose a restriction. So now you're no longer free to trade it. Makes it very unwieldy to do that. it's a little bit like jumping in the car and then all of a sudden you find out that you're no longer allowed to turn left. It's like, or hit the brakes. Yeah. Nobody wants to do that. No. You're not. You get in saying, "I've got control of this thing." The minute you cede control to somebody else, you're saying, "Well, it makes it a lot less appealing." CNBC, another example, right? CNBC, the employees of CNBC, now the contributors can and need to be able to affect transactions as a portion of their job and are often restricted from personal transactions as a result of it. But at CNBC, a lot of the people that work at CNBC, the reporters and hosts, and they don't trade actively. Again, because there's a lot of restrictions. So some of the things we were allowed to do without restriction was buy SPY, like a complete market proxy that was unrelated to anything we were otherwise involved with. So it couldn't be one of our own firms or whatever. Then you could trade that pretty much however you chose. But there was a lot of restrictions on everything else, and it varies from firm to firm.
Okay.
And it also changes over time. They impose changes. They did that to a lot of the retirement accounts at Canada. They had more flexibility, and then there was a big to-do about that, and then they ended up reducing it.
So then for regular retail investors, what would you say are the main advantages to use a cover call ETF versus rolling your own options?
Well, one of them is logistical, for sure, right? So, if you're doing something weekly and if you have a regular full-time job, maybe you can't be logged on all the time and say, oh, I need to adjust this now. I need to roll my strikes up, or I need to roll them down, or I need to roll out or down and out, whatever it is. That creates a little bit of an issue. There are other things too, which is, so for example, for a lot of the combos, we'll use flex options, for example. So the short put in a proxy will be a flex and the long call will be a conventional option. The logic of that being that if you are short an option, it is up to the holder to decide whether or not you get assigned. If it's a flex, you can use Europeans, so that doesn't happen. But if you're just selling regular listed calls, which we do, or selling call spreads, at some point those options may end up in the money and the other person may exercise the options and thus you are assigned. There might even be circumstances, it should never happen, but I'm not going to say it never does, that you could get assigned on an option that's even slightly out of the money. We did see that because somebody exercised an option when it was in the money, and by the time we got the assignment, it was out. And of course, that was good for us. It was only like 2 contracts out of 2,500 or something that we had. But that kind of thing can be a little bit onerous for individual investors to maintain. That said, do I think it's a good idea for people who are invested in strategies like this to, if they feel like they have sufficient skill, if they have the tools available and the time available to do it, do I think they should? Look, I think you can learn a lot more about options than I could ever explain by actually doing it. Understand the fundamentals and then go and see how these things behave in the real world. Do I think there's utility in that? Absolutely. Do I think most investors have the ability to maintain a portfolio of stocks where they're selling weekly covered calls and adjusting them all the time? For most investors, I suspect that's impractical.
Yes. I like these high income ETFs because I can invest in a lot of the things that I care about, but then concentrate on doing options on like the one thing I care about. And you could just concentrating on one thing and then I'm still making money. And also because I'm using margin with the ETFs, you can only lose as much money as you put into it. So it's better than call spreads sometimes, Yeah. Mm-hmm. So we are coming up on the 2-hour mark. So
didn't realize it. So it's been a very nice conversation. If the time goes as quickly as this has, then obviously.
Anyways, I think that is all the questions that I had for today. Is there any last things that you want to say to my audience?
I think because it is the new year, I would leave everybody with this, which is that you have an opportunity now to do a little bit of a reset. And, to say I'm going to let the past go and I'm going to try to be a disciplined person and a disciplined investor, and behave accordingly. And the other thing is, sort of like the rats, recognize that sometimes there's going to be some pain, and to know going into it that that's a part of it. I have found that in my own life, that and my own investing, that when I have accepted that aspect, there have been circumstances where I was able to lose, just ditch a losing investment and move on without even thinking about it, and just say, okay, this is now violating my investment rules. It's gone. I'm not going to think about it anymore. The things that haunt me are the times that I have not done that. I have never been haunted by looking back at saying, okay, this does not fit my investment criteria, and so I'm going to ditch it. That's it. And be disciplined. And if you do those things, I think you'll probably have a pretty happy and successful 2026, and you'll look back on this year and feel good about it.
Yeah, sounds good. Yeah. So yeah, it was really great to have you on. I don't do interviews
pleasure.
all that often, but this has been really enjoyable. So
I enjoyed it as well. Thank you very much for having me.
yeah, I'll see you next time.
Cheers.
Hey, before I let you all leave, I'd like to thank all of the members, and the members today get the full uncut version of what Michael and I talked about. So if you want to support me and know every part of the conversation, then it's available, and I'll talk to you later. Oh, also, have you all set your income portfolios for 2026, or are you still in the analysis phase? And I will talk to you all later. Bye.